JSE-listed Eco Polska Properties released their annual results with distributable earnings of 76.6 million euros, translating into distributions of 10.87 euro cents a share. Net asset value for the year increased by 39%. Joining us for the details is the CEO, that's Hadley Dean. Hadley, thanks for the time. I was just looking at those key numbers and they all appear to be pointing north, as I indicated on that graph there. Net asset value up, distributable income up, and I just calculated 87% here. Very nice indeed. I'm sure you've got many happy investors. Tell us the reasons behind the better performance.
Well, it's Poland. Poland is performing better than we thought. As you know, we're a pure retail property fund. So our assets that we own only own dominant, defensible and sustainable shopping centres in Poland. But the Polish consumer is consuming now like a Western European consumer. And when you combine that with the potential of the market, because when you look at the average monthly salary of a Pole compared to a German, we're let's say under 1,000 euros versus in Germany 3,000 euros. So the potential for growth is enormous. And when you combine that with falling unemployment and rising monthly salaries, the optimism is bright. Absolutely.
And I suppose shareholders, having received a distributable income that's up 87%, would be thinking, can we do this again?
Yeah, I mean, for like, when you're actually comparing this like for like, it's actually up 6.6% after pre or post tax. So but from a dividend forecast, this is exactly what we forecast in our IPO in September 2016. So, as always, these journeys are never sort of in a straight line, but footfall's up by 5%, sales are up by 7%, and I hope every year I can come and see you and announce such good results.
Absolutely, and in addition to that, you are adding acquisitions. I'm seeing some big numbers here, 334 million euros that you spend on acquisitions. More to come?
We will only look at buying assets that are dominant and defensible and sustainable. So yes, we will look at, but last year we had a very active year. Actually in January we bought another 4 assets. And we will continue to look at assets that benefit, let's say, the catchment area of the Polish consumer, because really what people are buying is our accessibility to the Polish consumer. Yeah,
and I saw that reference to that access for the Polish consumer, because at the moment I think the numbers that you have is 81% to 19% retail to office, right? And you want to move that further, because I saw again you're making reference to the fact that you want to be in 27 retail centers by 2020. Is that still premised on the basis that the consumer story is going to continue to be good for Poland?
Absolutely. When we look at when we set out our thesis actually to the market this time last year, we said we wanted to sell our office buildings to fuel our retail growth. And the reason being is not that offices are bad in Poland, but we just see more growth in Poland, because you've got dwindling supply in new shopping centres being built because the market's coming to capacity. You've got an increasing consumer demand. And we're in a very fortunate position, because we now will own by 2020 27 shopping centres, which will give us access to 40% of the Polish consumer market within a 30-minute drive time.
Yeah, and how much are you looking to spend on those acquisitions potentially? And is this just going to be Poland, or are you going to perhaps branch out and start looking at Eastern Europe?
No,
perhaps Western Europe? I don't know. Just putting in a question over there.
We're very focused on Poland. I mean, I think Poland is the kind of the darling of the European Union in terms of the economic figures at the moment. We're certainly seeing a solid, stable growth that we can forecast and build a business around. So Poland, for us, we're a Polish retail-focused fund, and we will look at acquisitions on when we see something that fits our investment criteria.
Yeah, and the outlook for the Polish economy?
Well, the GDP in the last quarter was 5.1%. The forecasts are 4.2%. When you add up the GDP over the last 10 years, it actually grew by 44%. I mean, Poland is a young Germany. It's just getting going. You've got this burgeoning and blooming middle class, which is now spreading with very low debt. So it's a very exciting country to be living in.
Yeah, I'm chewing in my head young German. I don't know how many are going to be happy with your characterization, but I understand what you're saying. And in terms of...
Well, maybe I should say a Germany in the 70s.
A Germany. Another German in the making. Another German in the making. Okay, sure. So the focus you're saying is going to remain on retail. What about the other spaces as well where opportunity arises, residential potentially, no?
Yeah, there are obviously, I mean, there are many different sectors of the property market, as we know. we believe in focus. I think if you focus on one asset class, you become the best in that business, and particularly retail, because 60% of retail is local. You need to understand your consumer better than your competitor.
Yeah, I try to look at your statement and I try to look for that prospect statement and try to see what potentially you're looking at in terms of earnings increase in the year ahead. Are you able to give me a number?
Yeah, I mean, we've issued guidance for 2018 and we're looking to deliver 11.6 and 11.8 euro cents a share, which is between 6.5 to 8.5% growth in DPS.
Absolutely. Happy times. May they continue.
Long may they.